In today's video, we're having a look at what the hawks and the doves really means for central banks. Hello and welcome to another ACY Securities market tutorial. My name is Alistair Schultz and I'm going to be your host through today's trading journey. Today we're talking about a few different things, but to start it all off, I want to just implicate the idea of what happens with hawkish and dovish behavior. You may have heard the terms bullish and bearish and heard it used to describe a trending market, whether that be up or down. You may have even heard about the birds and the bees, which is another common analogy that is used to describe certain behaviors not within the scope of this video. But looking at what hawkish and dovish behavior is really an idea of the same or before. It is the sentiment of what someone's understanding might actually be. In this instance, that sentiment is going to be related to what happens within a central bank. Sometimes it can be an individual, but most of the time it's about the actual actions of the central bank themselves. Nonetheless, the people themselves can also be that, and it's usually because they are the spokesperson for the bank and generally say the views of what the bank is actually thinking. So in the instance of the US, we have people like Janet Yellen, who is considered to be a dove or on the dovish side of that sentiment. We then have people like the current chairman, which is Jerome Powell, and he is in the middle. He is central. He is not a dove, he's not a hawk. He will mix and match depending on what is necessary towards the market policy at the time. We've then also got people like Loretta Mester, who is a hawk on the hawkish side of things and is obviously for good reason. Now, what actually goes into it? What are we really looking for when we think about dovish behavior and when we think about hawkish behavior? The reality of the situation is that it's all about the wording, and it really does matter. If you were to compare one monetary policy report to the next monetary policy report and you notice a significant but little detailed change, might just be one single sentence, then that is likely the area you are looking for. It might be indicating towards what their long-term, mid-term or short-term objectives are. It might be about what their target is and whether it's the inflation level being too high or too low. And it can also be looking at how they're going to use interest rates to try and curb the economy, depending on what kind of economic circumstances we're sitting in at the time. Now, looking at things from a hawkish objective, there are a number of different things to really consider, and these are the obvious pain points for them and what they're actually looking to do. So the main objective is really to decrease inflation. Now, if you were looking back in sort of the 1980s area where we saw higher levels of inflation, this is what they were aiming to do. This is why we had hawkish Fed chairmen and the like of monetary policy matching that. So we were seeing them having tightening restrictions. They were trying to make the money harder to get to. They were then having economic growth was already really strong, whilst the inflation was increasing. And then, of course, the interest rate in trying to combat the increasing inflation is trying to be raising rates to decrease that money supply again. Now, their whole main objective here is really to reduce the overall balance sheet expenditure and how much money's on it. Of course, the effect of doing so means that the currency increases in value because it does mean that it's got a strong economy behind it. Now, on the other side of this, we're looking at the dove's objectives or the dovish behaviors. The objective here is to stimulate the economy by any means necessary. Much like the hawks was to devalue or at least to stop the inflation from rising further. In this instance, it's about getting that inflation up there and getting the economy to grow. So we have loose monetary policy, which is the economic conditions that we're in under today. We then have economic growth usually being weak, hence why we're trying to have loose monetary policy. And of course, the inflation is either decreasing or potentially even negative in some instances. And we're trying to stop the idea of getting into a circumstance where we have stagflation or disinflation or whatever other method of inflation that might be responsible for the current circumstances. We then want to try and decrease the interest rate. We're cutting it to try and help that money supply. We're expanding our balance sheets, taking on more debt. And of course, the general effect is a depreciation of the currency. All of this means together that they have two very core objectives, either stimulate the economy or decrease the inflation. And when you do that, generally you will find that the person in charge at the time of the central bank will do anything within their power to make that happen. A perfect example is if you were to look back at 1979 at the federal chairman Volcker that we saw back then. He was adamant and quite tough on monetary policy in the attempt to try and bring inflation back down. Whilst now, where we're seeing with even going back before to the GFC with Ben Bernanke, or now where we've got Jerome Powell, you'll see that the monetary policy is very loose. The money supply is increasingly easy to get, and the inflation levels are still remaining subdued. So for next time you are looking at a monetary policy report and you aren't quite sure what might be happening, this is the way for you to find out. Now, if there's anything from today's video that you would like to get in contact with me about, feel free to shoot me an email at talk2al@acy.com. And of course, like and subscribe this video so you can get more great content from me and ACY Securities in the future. Have a great trading day ahead.